Welcome back. Last week we finished up chapter 1, and what we're going to do this week is, of course, start in chapter 2, and we'll start by analyzing the same transactions that we did last week in chapter 1. What we want to accomplish in this chapter this week is the first thing we want to do is describe the characteristics of an account and a chart of accounts, describe and illustrate how we journalize transactions using a double entry accounting system, describe and illustrate the journalizing and posting of those transactions to the accounts, and then the last thing we'll do is prepare an unadjusted trial balance and explain how we can use it to discover any errors that we may have made in recording our transactions, and show how we would use it to adjust our accounts. The first thing we want to do is talk about what an account is and what a chart of account is. An account in its simplest form has three parts. It has a title, and that would be the name of the account as it's shown in the accounting equation. Examples of titles would be cash, land, accounts payable, Chris Clark Capital, Chris Clark Drawing, fees earned for his revenue account, rent expense, utilities expense, supply expense, miscellaneous expense. Those are examples of the expense accounts, and all of those are accounts. In describing, illustrating how we would record these transactions in a dual entry accounting system, we use what's called a T account. This T account is really just an account that we use. It's not a formal account form. It's just something we use as a training tool, and it's also something that we'll use sometimes as a way to explain something to one of our coworkers. The T account has a title right up at the top, and you can see why it's called a T account. It looks like a letter T. And the left side of the T account is called the debit side. So debit, regardless of what you've heard prior to this course, debit just means left side. The right side is called the credit side, and so debit means left side, credit means right side. We're going to take a look at how a T account is used. We're going to first take a look at if you look up at the top of page 51, you can see all of your transactions that we did last week. And we're going to look at the cash account in a T account. If we take the cash account and we put it in a T account form, that plus $25,000 is shown as a debit on the debit side of the cash account. So if we want to increase our assets, we always debit the assets. If we want to increase our liabilities, we always credit the liabilities. If we want to increase our capital account, we credit the capital account. So if we took a look at our accounting equation, we have assets on the left. So remember, anything, if we want to increase any asset account, we're going to debit it. And our liabilities and our owner's equity is on the right side of that. So if we want to increase our liabilities or our owner's equity accounts, we'll always use a credit to increase those. So debit just means to the left, credit means to the right. If we want to increase assets, we debit them. If we want to increase liabilities or owner equity accounts, we credit them. So if we look at our cash account, we see that we have a debit for $25,000. That's where Chris Clark took the money from his personal account and opened up an account for Net Solutions. And then the next thing Net Solutions did was Net Solutions took $20,000 of that and paid it for a piece of land for a future building site. So we've got a debit for $25,000, a credit for $20,000. So at that point, if we looked at our debits and credits, we'd have a balance of $5,000 because we take the debit side, the debits, and subtract the credits. Take the 25, subtract the 20,000, and we have $5,000. The next thing that happened with Net Solutions was it received $7,500 in revenue. So we debit the cash because we're increasing our cash. And then the next thing that happened was we we paid our expenses, our wage expenses, our rent expense, our utilities expense, and our miscellaneous expense, and those all totaled up to $3,650. So we have a $3,650 credit to cash. So if we took the if we take the 25,000, subtract the 20, add the 7,500, subtract the 3,650, we'd show our cash balance at that point. And at that point, it was $8,850. The next thing that happened was Net Solutions paid $950 of that liability for the supplies that it had bought on account. And if we subtract that, then we have a cash balance of $7,900. And our last transaction, Chris withdrew $2,000, so we have a $2,000 credit to the cash account, and it makes our cash balance $5,900. So each one of our accounts, cash, accounts payable, Chris Clark Capital, each one, if we take all of those accounts together, that group of accounts is called a ledger. And then if we list those accounts from the ledger, go to our ledger and listed all the accounts that's in the ledger, that would be called a chart of accounts. So a chart of accounts is a list of the accounts in the ledger. The accounts that are listed in the chart of accounts and in the ledger according to the way that they're shown in the accounting equation. So the first thing we would do is list our assets in our chart of accounts. And if you look on page 53, you actually see your chart of accounts. First thing we list is the assets, and then our assets are characterized, or examples of our assets are cash, supplies, accounts receivable, prepaid expenses, buildings. All of those are asset accounts. The next thing we would list in our chart of accounts is our liabilities. And remember, the only thing Net Solutions had was an accounts payable, but I mentioned that those accounts are normally due in 30 days. If we had payables that were due longer than 30 days, those are normally witnessed by a note and notes payable. And we can also have wages payable, because we incur the expenses this week and we normally pay them at least a week later. Sometimes, some people are on where they just get paid once a month. So you have accounts payable as those wages are accruing and haven't been paid. The next thing we list in our chart of accounts is our revenues. And remember, revenues are increases in the owner's equity account as a result of selling goods and services to our customers. Some account titles that we use for our revenues are fees earned, commission revenue, and rent revenue. The next thing we would do is list our expense accounts. And expenses are using up assets or consuming services in the process of generating revenues. And examples of our expense accounts are wage expense, rent expense, utilities expense, miscellaneous expense. All of those are examples of our rent expense. And we'll stop right here, and we will pick back up in our next section on page 53 and start talking about the dual entry accounting system. Thank you, and I hope you have a great